everybody. Welcome to Cigars and Syndication. I'm Robbie Rogers, and we're very passionate about cigars and very passionate about real estate.
Hey, welcome to Cigars and Syndications. My name is Junaid Noor, and welcome to this episode. What are you smoking here today, Robbie?
We are smoking a David Off, the Masters Selection 2012, and I'm not even sure how you managed to get these. They only made 1,500 boxes back in 2012, and it had 2-year aged filler, the same filler that they use in the Yamasa, but aged in bourbon. This thing is miraculous.
No, this is an amazing cigar, and shout out to Sammy out at Casa de Monte Cristo up in Chicago. I went up there last month, and he took me into his vintage storage, and he had a box of these, and I grabbed a couple, thinking, hey, just haven't tried these, and so let's give it a shot. But this is an excellent smoke.
Oh, just from the first light, I get like a roasted nutty. I get a really oaky, earthy, smooth draw. It's a really amazing smoke so far. I'm looking forward to getting all the way through it.
Yeah, I get some spice in the beginning. It's very earthy, nutty. Yes, Davidoff just doesn't. They don't disappoint at all.
Today we're talking about something that's probably on a lot of people's minds, and you've probably seen it come across your news feed or your business feed. And is the commercial real estate market going to crash, or is it going to have a really big negative impact on things around you? But that's what we're going to talk about today, and hopefully we can kind of shed some light on some of your fears and concerns.
Well, the first thing is that there's a lot of people out there. There's a lot of clickbait out there on that the housing market is going to crash, like it did in 2008, and there's no indication. It's just clickbait. There's a housing shortage right now. Um, a lot of people are tied into low fixed rate interest rates, so they're not ready to sell. We don't have this big boom of variable interest rates that are going to reset. The housing market looks very good, and unlike 2008, it's very stable right now. So, I would say don't fall for the clickbait. There is no shortage in the housing market, but commercial is a different story.
Yeah, with the housing market, I mean, it's really seems to be very resilient. I believe a lot of people, the value of their homes has remained stable, even though the interest rates have risen. Usually, they're indirectly proportionate. As the interest rate rises, the home values fall. Well, in this particular market, we haven't just seen that, and in the market prices are holding pretty steady, and at least in the Houston market, the housing market's still very aggressive. I mean, there's multiple bid offers on homes, and it's actually just a newer market to the Houston market.
Yeah, and the last few episodes we did, we talked about why and how we traced it all the way back to 2006 as to why there's a shortage of housing. And so if anybody wants to go, they can go look at our YouTube channel, subscribe to our YouTube channel, and there are episodes on why the housing, what we have a shortage in housing. But it doesn't look like it's going to crash anytime soon. Housing is doing really well. There's not enough housing, and um, the prices keep going up because there's just a shortage.
And the next biggest elephant in the room is the commercial real estate market and what's going to happen there. I think that there's a lot of speculation that it's going to crash. You wrote a wonderful article that's posted on albanyparkcapital.com. Um, they allude to some of the things that have led us to this current market situation, starting all the way back in this terrible word COVID.
Yeah. So, commercial real estate can be broken down, and there's a lot of different commercial real estate assets, but it could be mainly broken down into three categories, which is, uh, I'm sorry, four categories: multifamily, office, retail, and hotels. Those are your main drivers of commercial real estate. Then you have some self storage, and you have RV parks, and you have other assets that are smaller. But your main when you're talking about the commercial real estate market in the United States, you're talking about multifamily, hotel, office, and and retail. Retail.
In the article you wrote, you kind of hit on something that's incredibly interesting to me, and it's just about all of these loans that are coming due, whether it be in the hospitality industry or multifamily or commercial office space. You have a lot of loans coming due, and what are the implications of these coming due when the interest rates are considerably higher they were when they originated the loans?
So, if anybody's wondering how to relate this to the 2008 market crash, this is how you relate it to the 2008 market crash. In 2008, you had homeowners who were not making enough money. Their interest rates went up. The value of the house was going down. And so their payments went higher, and they went much higher than they could support, that their debt service could support. Well, this exact same scenario is happening in the commercial market right now. So let's start with hotels. Right now, for most office buildings, I'm sorry, let's start with office buildings because that's like the biggest elephant in the room, right? What's going on with office buildings? So office buildings need they can handle about a 15% vacancy rate. That means 85% occupancy in order to break even. And right now, because of COVID and because of work from home, you have places that have 29% vacancies. Like San Francisco has 29% vacancies. 18% vacancies are across the board. So most office buildings are not even breaking even.
And the loan instruments on those types of investments, they can be variable as well, which would also impact their NOI negatively, right?
So most commercial loans are 5-year loans. They reset in 5 years. So a lot of these office buildings are they're coming up to reset their loans. They're coming up on their 5-year mark. And, just like in 2008, when homeowners whose interest rates reset to a higher level, but their income stayed the same, or maybe one person lost their job, so the income was cut in half, could no longer afford the house that they lived in. Well, office buildings are the same right now. They're in the same position. Interest rates are higher, vacancies are higher, so that means the income that's coming in is not high enough to support the existing interest rate, let alone the new higher interest rates, which are going in right now at about 8.5 to 9%.
And when you talk about those things happening in the market and potentially these properties losing value, what does that do, in relation? In a previous podcast, you talked about mark to market. Does that have the same effect in the commercial market as it does in the real estate, in the residential market?
Absolutely. So now we go to the 1-2 punch, right? The one punch is COVID-19 happened. Everybody's working from home. Corporations are downsizing. Vacancies are increasing in offices. And so, the income is not there to support. And then, the interest rates have gone up to try to control inflation. So the income is not there to support higher interest rates. So the other problem is mark-to-market accounting. So most of the commercial real estate in the United States is the lenders are mid-sized banks. So think Silicon Valley Bank. So the large banks like Chase, Bank of America, their real estate portfolio is only like 6%, of their entire loan portfolio. So they're not really exposed to commercial real estate as the mid-sized banks are. Now, the mid-sized banks average about 33% of their portfolios in commercial real estate. So now we come back to mark-to-market accounting. A mid-sized bank like Silicon Valley Bank or one of the other banks who are all in trouble has an office building on their balance sheet as a loan. Well, because the rents have dropped, vacancy has gone up, the value of that office building has dropped. Well, now that the value has dropped, the bank is required to reduce that value on their balance sheet and take that loss as a loss on their income statement. So now, because they have this big loss on their income statement and they've reduced the value of their assets, their lending ratios have dropped. So now they can't lend anymore.
which really complicates things for getting projects started, getting new developments going. Interest rates are going to continue to go up. Credit's going to be harder to get and tougher to get. You're going to have to be well qualified, probably bring a little more equity to the table, which just kind of slows everything down a little bit.
Yeah, and it'll be very interesting to see what happens with these office buildings. And like I said, that in San Francisco, 29% of the office buildings in San Francisco are vacant. I mean, it's a ghost town.
So the big question is when is there a return to normalcy, and is there a return to normalcy? My own personal feeling on that is that there will be most of the market will recover from office space, but I do think there's still a large portion of uh, this new push to work from home, or at least partially work from home.
Yeah, no. A lot of the large corporations, even if they're requiring their people to come in, their employees to come in 3 days a week, they still don't need the office space that they used to have. So they'll maintain some semblance of office space, but they're downsizing. So they don't need the thousands and thousands of square feet. Um, my prediction: office space will take about 10 years to recover. And keep in mind that it's not just the small, syndication that has an office deal that's going belly up. I mean, Brookfield Asset Management, which is a very large hedge fund, they have a lot of office space. They basically turned in their keys to some of their office buildings back to the lender and said, we can't do this.
I mean, it's really crazy to think about that. I mean, it's definitely definitely a different market and different time right now. And do your due diligence and do your homework, and invest wisely, especially when it comes to commercial real estate. I think there's probably going to be some challenges. I think you're right. It's going to be a bit before these leases get full again.
Yep. So, in the next segment, or the next asset class that I want to talk about, is hotel and retail. Now, even though you'll see a lot of people are coming back to the mall, e-commerce really the COVID put a lot of hamper on the retail market. And because of e-commerce, everybody's gotten so used to shopping on Amazon and shopping at from Walmart.com or Target.com and having it delivered to your house for free. People are not coming back to the shopping malls as they used to, and now you're seeing a lot of the retail stores going belly up as well.
I like to call that the Bezos factor, and it really has changed the game. And these retailers with the brick and mortar stores are going to have to get creative. And I don't know if Bezos can deliver the Master Selection 2012 Davidoff like you did, but it's a great smoke, and it's very enjoyable.
No, so far it's really mellowed out, and I'm really enjoying the draw. The spice is gone. I'm getting a lot more chocolate, a lot more nut. Very well done.
Yeah, no, I'm getting a little chocolate, a little coffee. Definitely the roasted nut continues. Not very spicy. I would say probably on the lighter side of a medium bodied smoke.
So going back to retail is going to have the same problem. You have a shopping mall, and as people stop coming, those smaller stores or even some of the larger stores are going to go belly up, and they're going to leave their space vacant. And 46% of all retail loans are made by mid-sized banks. And because they don't have the income anymore, the value has gone down. Because remember, commercial real estate is not like a residential single family homes. You can go into a residential single family home and fall in love with the neighborhood, fall in love with the school district, fall in love with the kitchen, fall in love with the pool. And so prices are based on emotional factors of consumers. Commercial loans are not like that at all. Commercial loans are based on net present value of cash flows. That is it, right? So if those cash flows go down, the value of the property goes down. And in 5 years, when they come up to their 5 year mark, retail is going to suffer the same problem. The value has gone down, And now they can no longer refinance. And then, of course, the mid-sized banks, they have to mark it down on their balance sheet. They can't refinance. They can't do the loan at all.
And I think with all bad things, there are some good things, right? There's some good opportunities that are going to present themselves to people that are positioned to take advantage of them. And I think that's what the next step in this market is position yourself to be opportunistic and take advantage of some of these scenarios and some of these property opportunities that might present themselves.
Unfortunately, what I think is going to happen is that the big banks are going to start stepping in. Chase just bought out First Republic Bank, and they are already the largest bank in the United States. They're going to have to step in, or the federal government's going to have to step in. Back in the 80s, RTC, when the savings and loans failed, the the federal government formed a corporation called the Resolution Trust Corporation, RTC, which acquired all the assets of these savings and loans and then recapitalized them all. Either that's going to happen or the big banks are going to start stepping in and they're just going to start getting bigger and bigger and bigger. And unfortunately, what's going to happen is that the mid-sized banks are all going to be gone.
So that leaves hotels and how they fit into this market. What do you think? Are they in a similar situation with how they structured their loans and their deals?
Well, yes, because hotels are having the same issue, right? Business flyers, or business people who are hotels' main customers, not the consumers, are not going through conferences anymore. They're not going to meetings as much anymore. Everybody's doing much more on Zoom, right? It's a lot easier to sit at your house in pajamas and do a Zoom meeting. And why do I need to fly out there someplace and spend a night in a hotel when I can be at home? So the interesting thing is that with hotels, just as with retail, 37% of all hotel loans are with mid-sized banks.
Well, that's really going to create some issues and force people to get creative in maintaining these properties. And again, I think creating opportunities for people that might be positioned to take advantage of those.
So one more statistic I have is that 30% of all hotel loans, which is almost $31 billion, are going to mature in 2024. And they're going to have the same issue: high vacancies, low income, which means lower value, which means they can't afford the new higher interest rates.
Well, hopefully there's somebody there to catch them all.
Yeah, right. So, but this is not all doom and gloom. There are some good opportunities out there, and we haven't even, I think in the next episode we'll touch on multifamily and the opportunities that are going to be available in the multifamily sector with all this doom and gloom going on.
Well, we're going to wrap up. This is part one of a two-part series. We're going to continue to talk about, whether the commercial real estate market will crash. I'm going to continue to enjoy this Davidoff and look forward to seeing you at the next episode.
Make sure you visit us on www.albanyparkcapital.com. Hit the resources tab. I have articles. I have an article on this episode and the next podcast we're going to be doing, which is will the commercial real estate market crash? And then follow us on on all our social media.
And keep your eye out for Byron Estates.
Yes. Keep your eyes open for Byron Estates.